Thanks for tuning in to the Lean 911 podcast, where you'll have a voice directly from the Gemba. I will rely on my 3 decades of Lean successes as well as my failures to answer your most challenging questions regarding your Lean transformation. I'm your host, Mark DeLuzio, President and CEO of Lean Horizons Consulting and the Principal Architect of the Danaher Business System. Looking forward to your questions. Now, let's go to the Gemba. Hi, Mark DeLuzio here, President and CEO of Lean Horizons Consulting and the Principal Architect of the Danaher Business System. The next 2 episodes, this one, episode 11 and 12, kind of go together, but they have to be done in a particular order. I'm going to be doing Lean Accounting, and the second one, episode 12, will be Accounting for Lean. And there's a difference. I'm going to explain that in a minute. So I'm breaking this up into a 2-part series, if you will. Both are pertinent if you want to venture into this area. And I want to start with Lean Accounting. For those of you watching on YouTube, I'm going to share my screen and show a presentation. Otherwise, sit back and listen, and you'll hear a little bit about how we thought about the accounting process, particularly the cost accounting process, differently than what we all got taught in school. So give me a minute here while I share my screen, and here we go. Okay, so you notice again that this says Lean Accounting and Accounting for Lean. We're talking about 2 different things. And again, this episode 11, is all about Lean Accounting. Now, our agenda is going to take us all the way through, again, in a 2-part series. The introduction, I'm going to talk a little bit about upfront what these 2 definitions mean. I'm going to give you a case study on Lean Accounting, and then I'm going to break it off from there and start the next episode, which is the case study on Accounting for Lean. And I'm going to talk to all the accountants out there in terms of what has to happen in order to convert from a traditional management accounting system to a Lean accounting system. And then we'll wrap it up from there. So let's get going on an introduction. First definitions, Lean accounting. It's simply applying Lean concepts and methodologies to drive waste out of the accounting process. No different than you would take the concept and philosophies and tools of Lean to drive waste out of a manufacturing process, an insurance claims process, an order entry process, a new product development process. And in this endeavor, we're looking at the same waste that everybody else looks at, the traditional 7-0 wastes, and we're trying to drive those out of the particular process. Now, the accounting for Lean is modifying the accounting process and internal management reporting to properly deliver financial and operational information, which promotes Lean behaviors. Now, you're going to find when we get to that section in episode 12, many of the old traditional cost accounting, variance analysis, efficiency analysis, standard costing drive the exact opposite behaviors that we're trying to, bring into our culture. And if we don't get this part right, the accounting function itself, the finance function, can actually derail the entire Lean transformation. And I've seen this happen countless times, and many have written about it. But this all came about back in 1989, where I believe I was the first to actually implement Lean accounting. Matter of fact, the guys over at Wiremold, Ori Fumi and all that, Art Byrne had him call me to benchmark what we were doing there. And then a bunch of other people followed after that. And, we didn't have any books on this. We didn't have any consultants. All we did was say, okay, well, look, let's look at the behaviors we want to drive, and let's look at the accounting process that is preventing us from doing that. So we'll get into that more in the second part of this, but right now I want to talk about how we applied Lean to the accounting process. So now, what are the benefits from Lean accounting? Obviously, eliminated waste. I already talked about that. More timely information, improved quality of information, frees up accounting resources. All right. And it allows the accountant and the financial arm of the company to be more navigators than they are historians. How many times do the accounting people put all the reports together, takes 2 or 3 weeks to close the books, and they could tell you what happened last month, maybe, if the if the data is anywhere near meaningful. Most accounting data today, when you look at the profit and loss statement, the balance sheet, and the cash flow statement, are not good enough to really understand what's going on in the business. And again, I'll talk about that more in the second part. But if we don't take the waste out of the accounting process, we will never have a chance at doing the second part, which is accounting for lean. And that's something you got to keep in mind here. A lot of people want to run right into, accounting for lean, but they're not applying lean to their own process themselves. So it allows you to be a lot more customer focused, provides internal customers what they want when they need it in terms of trying to drive the right decisions, and it eliminates unnecessary reporting, which I will definitely talk about as we move through. The accounting for lean, again, I'm just going to touch on this for a minute because we'll get more into this a little bit later, but all the things that we do with absorption accounting, with the whole notion of indirect and direct labor drives the wrong behaviors, purchase price variance, all the variance analysis. Most analysis that I see on standard cost deviations, they talk about why the standard's wrong. They don't talk about performance, and you can't really with a standard cost accounting system. It drives more accurate direct cost to the value stream, and even down to the cell level, where you get absolutely very accurate product costs because you're not spreading your overhead like peanut butter across the business. Okay. Cost data is not arbitrary, and you at least have a vehicle to control one's destiny. And I'll talk a lot about the millions of dollars we saved just because of the accounting system that we put in, the lean accounting system back in 1989. We saved millions and millions of dollars of spend because of avoidance of capital. As a matter of fact, I have a separate podcast on how I looked at capital equipment, which is really part of the accounting for lean part of that, and I'll talk about that then. But there's a whole section specifically on that one aspect of the process that I put in place. Now, I'll have to say that I was very lucky to be able to do this because I had leaders, George Koenigsegger, Art Byrne, Bob Pentland, who's an unsung hero, our VP of operations, who supported me wholeheartedly on doing this. Without that leadership support and understanding, this never would have happened. Okay. Let's talk about a case study. Now, some of this is going to be a little bit dated because back in 1989, I'm going to be talking about the accounts payable process as an example. We did this with a lot of other processes too, like the closing process, the receivables, and all kinds of other things that we did. But I'm just going to pick on the accounts payable process. But it was a bit archaic back then in 1989 compared to today as to how we process invoices. But you're still going to have to bear with me on that because the message and the lesson learned are in fact still relevant. George Koenigsegger actually told me once, of all the areas in the business, Mark's finance team achieved the largest productivity gain in all of Jake Break. All right. And I'll show you those numbers in a minute. And by the way, we did not let people go out the door. We had a no layoff policy, which is another part of accounting for lean, that if you don't have that, you're never going to harness the creativity and improvements from the operators. They're going to always be looking for ways to guarantee their employment, if you will. A subject for another day. Okay, so let's move on. Here's the situation analysis. I had 25 people in my business. We were $65 million. We had 100% market share, but our biggest customer took a third of our business away. That was Cummins Engine, which ironically Cummins just bought Jake Break last year, I believe. But I had 25 people. You can see the distribution here. I had 3 in accounts payable, 1 in accounts receivable, 2 in general accounting, 3 in payroll, 4 in cost accounting, and in information systems, we had 12. So I had 25 people. By the way, information systems, you'll see later, we took that down to roughly 2 or 3 people because we had a big IBM 4381 mainframe Halon system. It was a batch system, and it was way overkill for what we needed for this business. But anyway, let's move on with accounts payable. Okay, very simply, our mail was delivered in an envelope. Okay, I remember what time frame we're talking about, 1989. Mail got sorted. Believe it or not, I had 3 accounts payable ladies working for me, and one lady did vendors that started with an A through, I forget the letter K, and then the next one did L through, I don't know, S, and then the others did T through Z. Okay, so even if a vendor called up with an inquiry, and let's say Nancy got Acme, but she didn't do the A, she'd have the guy call back to talk to Mary, who did the A's. Okay, so that's how crazy it was. But we sorted all these hundreds and hundreds of envelopes every week into their respective piles. Okay, we then opened the mail. We created batch control totals. So we took a bunch of invoices, added them up, got a total number of what we were supposed to pay, because that's what the computer system wanted us to do. And then we entered them into the system. And then we found that, oh, geez, didn't have a purchase order. Oh, geez, unit of measure is wrong. There's no purchase order. Price was different than the PO. I mean, we had all kinds of issues. So a majority of our time was spent correcting the exceptions. And then, of course, once we got all that done, we filed the vouchers, and never did we hardly ever go back to those filing systems. But the bottom line here, everybody looks at productivity, okay? And there's so much time and attention, when your total costs are 12, 13% is labor, and there's so much time and attention spent on driving productivity and all the systems and time clocks and everything else. But at the end of the day, productivity is a function of quality. And Deming said that. I have a quote here. It says, if you want to improve quality, if you improve quality, you automatically improve productivity. Okay, there's a direct cause and effect relationship. If you want to just focus on productivity without causing the drivers that cause you not to be productive or efficient or whatever word you want to use, then of course you're going to lose. It's like focusing on your scale, the weight on your scale when you want to lose weight, and ignoring calories, nutrition, exercise, and all that stuff. Okay, I'm not saying you don't look at the scale, but you got to drive those other things in order to get the result once you step on that scale. And that's the mistake a lot of people make with cost, and especially with productivity. Okay, so our biggest problem, although we had a lot of problems, was this whole quality thing that we had. So we said, okay, well, what are we going to do about that? The quality errors, I have a very simple Pareto here. I know those of you listening can't see it, but I'll tell you our biggest issue was we had most of our invoices were either missing a purchase order or there was a unit of measure problem. We ordered it in gallons and they sent it to us in pounds or whatever the case may be. Wrong quantity, no receiver, and then a bunch of other little things that kind of added to the fire, right? So we actually started posting all the different quality problems with the invoices, and we started looking at them from a lot of different ways. I'm only showing one overall Pareto here, but we looked at it by vendor. We found there were certain vendors that were culpable. We looked at it by initiators of the purchase order. We found engineering, for example, were big violators of just going out and buying stuff with no PO. And they had vendors that would allow them to do that, right? We found, fundamental problems with how we ordered materials relative to unit of measure. We were missing receivers. We had a lot of holes in our system. So a lot of times when you look at an accounting function and you say, well, geez, they're inefficient. Usually they are the benefactors, or I should say the victims of other processes within the business that are broken. So most of our time was spent, 75% or so of our time, trying to track down all these problems. So now that's the beautiful batch I put together that said I should pay X number of dollars out. I could never finish the batch because the invoices kept bouncing out. All right. So we started doing Kaizens around each type of defect, and it was a multifunctional thing. We had to get purchasing involved, receiving, engineering. It was not just an accounts payable problem. Okay. We use visual controls. We started eliminating these quality defects. All right. And all of a sudden, before you know it, we became very productive as a business, as a function. So what do? We developed standard work, and I'm going to show you that in a minute. Real standard work, by the way, for accounts payable. Okay. We designed actually a accounts payable cell in terms of how we flowed invoices through that cell. And we had three major product families. We looked at these from a product family perspective. One was inventory. Of course, we had a lot of invoices for inventory. Another was non-PO type stuff, like you get electric bills and things like that, expense reports, all these kind of things that were off the grid when it comes to purchase orders. And then all the other MRO type stuff. People ordered office supplies and engineering supplies and things like that. So those are three major families, if you will, that we had to look at. Each one was a little bit different. We even broke down the errors in those categories as well. So when you do a Pareto analysis, and I think I'm going to have a separate podcast on how to use a Pareto, which is invented by Dr. Duran. He adopted that into the quality circles. Matter of fact, I have a podcast on Duran, and when I asked him, and I knew Duran, when I asked him, what was his favorite quality tool, it was the Pareto analysis. He said, "Why not? I invented it." One piece flow. Okay, in this case, one invoice flow. We had a hospital bed for quality defects, so we could actually quarantine those and actually analyze those and figure out what was going on, right? And they implemented root cause quality tracking and improvement system. Okay. Now, we actually created a standard work combination sheet. And if you're looking online, I'm showing you one right now where I detail the actions of an accounts payable clerk and what they had to do relative to entering one invoice into the system. Now, back then we had 150 per day. So that means in the available time, our takt time was 180 seconds. And if you look at how we would process this, it only took a total, without any Kaizen now, of 120 seconds to process one invoice, basically 2 minutes, all right? But our takt time was 180. How is it that we had three people? Well, we had three people because we can never perform to this standard. And this is why standard work, one of the reasons why it's so darn important. I meet so many companies who say they're doing lean, and they're basically saying, geez, we're not doing standard work because, I had somebody not too long ago tell me, Mark, do you know how long it would take for us to put standard work in place? No, why don't you tell me? I've never done this before, but Ono even said without standards, there can be no improvement. Okay. What exactly are you improving if you don't have a standard? So this was our standard work. So basically, we had a takt time. We had to get one invoice done every 180 seconds. However, our cycle time was only 120. So by definition, there's no way we should have used three people. But we had to because of all the errors and problems that we had. All right. So when we got done with this, I would say this is about maybe a 6-month endeavor in terms of getting to a decent point. We were able to reduce our headcount by 2 in accounts payable. Right, went from 3 to 1. We also, by the way, was able to incorporate accounts receivable into that same person, into that same department, if you will. So our productivity went up by 200%. The quality, still not perfect, went from 650,000 parts per million to 50,000. So 650,000 parts per million. That means 6.5 invoices out of 10 had problems with them. Okay, that's how bad it was, right? And we eliminated duplicate payments. That was something that we tracked, and we also eliminated duplicate filings and all the other duplications that go along with it. Okay, now our headcount, when you look at the total accounting process, we went down to 10 people from 25, and those 15 people, all but one, was assigned somewhere else. Matter of fact, one of my ladies in the IT part of my business, my department, went to be a buyer planner on the shop floor. Okay, one person went over to run the CAD system in engineering. We had accountants. The VP of we had a VP of IT. He went to become an operations manager in one of the business units within the business. As we restructured the business to focus on customer-focused value streams. Okay, so everything happened then. Now I'll talk to you more about what happened to my accounting managers when we get to the second part of this on the next podcast, because that's an interesting career development for them, and it was a very interesting move for them that was unbelievably beneficial not only to them but to the company as well. Okay, so anyway, that's kind of where we are. So I guess the thing I'd like to say here is when you look at the accounting function or any other function, you've got to remember that when you're trying to do breakthrough and transformation, you cannot do it if you have chaos in your fundamental everyday daily management systems. The firefighting will bring you down into the bowels of the company every single time. And you will find yourself firefighting and working in the business, not working on the business, trying to build a better mousetrap. And that's what Kaizen is all about, right? So we knew that in order for us to do the right thing with accounting for lean, we had to get all of this right. We had to take our closing down from 2 weeks to 2 days is what we did. And I'll talk to you more about all of that stuff on the next podcast. So anyway, just want to share an example. This is a prerequisite for you to do accounting for lean. Okay, so there we are. Thank you. We're going to get on to the next session, and we'll see you next time. Thanks. Thanks for listening to the Lean 911 podcast. I'll be happy to address your questions or feedback on future episodes. Email me at mark@lean911.com. You can check out our other episodes by visiting our website at lean911.com, our YouTube channel, wherever you listen to podcasts. This is your host, Mark DeLuzio. Thanks for listening.